Hey guys, Freaky Finance here. Today we're just gonna do like what I like to do every year end, just look at the performance. Now the year end's not over yet. There's a couple of days trading. It's actually live right now on December 27th, 2024. Anyway, things open down, so the numbers will change near the end of the year. But this is my process that I do at the end of every year. I like to go back and see how things performed, and it's one of the things that I look for opportunities in the next year. I've already done it, so I'll just try to summarize things. But basically, I like to look at the year-to-date performance, see what's performed well, what hasn't performed well, and cross-reference it to what I already own and what I'm currently already doing or what I'm thinking. And especially against the businesses that I really love, like, how I've been very vocal at Airbnb and it didn't even perform at all this year, right? So, whereas Booking, which has worse revenue and worse earnings per share growth and worse scale because it has to pay so much to Google for advertising, it's quite a bit of their cost structure. Airbnb doesn't do that, and it barely moved at all. Part of that is evaluation, but we've talked about Airbnb enough. But anyway, it's kind of like what I like to look at where I could see opportunity next year. And we did the same thing here. So this was 2022 when we did it, January 2nd, 2023, the video. And again, it just helps me. It's like a cross section in time, and I can go back a year later and see like, hey, where are things at? Like, what was I thinking? What was right? What was wrong? And keep augmenting. And it's just fun to go back in the channel, like even 2 years ago. And when I started the channel, right, I've probably, like, I think the portfolio has gone from like 150,000 to probably 500,000 just by reading. So anyway, happy holidays, Merry Christmas. So we're gonna go through some stuff here. But this is generally the process, just like we did in 2022. We were like, okay, there's things here that could be valuable, right? We picked up Meta, picked up Microsoft, we bought Amazon a bit. We did buy Google lately again, and in that year. So it does work like we did by PayPal, but we were early. That stayed forever cheap for a long time, and it finally rallied this year. But that's kind of the process. So I look for things that I like and businesses that I like with it. So that they've underperformed on the year, and I like the business. That's the crux of it. Let's jump to this year. So you can see one of the things here in semiconductor land, NVIDIA with AI shot up quite a bit, right? And this is after 2023, which is also strong for NVIDIA. AMD, on the other hand, has gone down 16%. And this is interesting because AMD, when I look at the latest call, it's actually accelerating. It's actually picking up part of the data center GPU market for AI, specifically with Meta and Microsoft. And it's interesting because we saw this trend with Intel when Intel was ceding share to AMD, specifically with the chiplets and EPYC on the CPU side. So now all of a sudden AMD basically had zero business in the GPU side, and all of a sudden has 10% of the AI market. Now, I mean, 90% is NVIDIA, and Blackwell is superior. But it's worth noting that the market's basically saying AMD isn't going to win in AI at all, even though the revenue is already accelerating and earnings per share is actually accelerating. So that's something that I'm excited about. So I've actually started a position on that, and we'll go through my positions near the end of the video. This one's longer because, again, this is more for me. I just love to think out loud, and this helps me see if I was right or wrong during the year, and basically how to improve going forward. So anyway, I've started a position in AMD just because revenue and earnings per share growth look like they're accelerating. Though again, Blackwell does look superior to what currently AMD is about to put on the market. Though that may change, but at the same time, it's not priced like it's literally got from, I think it's like $1 billion business already, and from zero, right, on the GPU side. So anyway, PayPal's one has performed. I might trim a little bit more in the new year. It kind of depends if I see other opportunities, and that's kind of the jux of it, right? Like, I still love Pinterest, which hasn't performed this year. Airbnb. I've started to add to Uber again. What I've been doing is, because I don't want any more US dollars, is that I'm basically, I owned Uber in US dollars, and what I'm doing is selling it in a non-taxable account and buying it in Canadian dollars on the CDR side, and that way I don't have to, and it's freeing up US dollars so I can buy other things. And specifically what I've been buying, it's AMD, but I've also been buying Dollar General, which is another company. Like, you see Walmart and Costco like 40 and 50 times earnings, right? Here, let's just do the P's really quick just to see. Now, everything's really expensive, which is always scary, right? We have had some really strong years in equities, right? And we've been overweight equities, which has been nice. But anyway, you can see the valuations here aren't exactly great. You could have said the same thing last year, but so we are probably, it'll be harder to make as much money as we made last couple of years in 2025 probably. But I am looking for deals, and there are some deals, right? There's always somewhere to look. You keep trading over rocks, but you can see like the PEs are very high. Dollar General for reference around 12 right now, and these numbers aren't adjusted, right? These are just the gap, which can be misleading because there's a lot of noise. Like there can be a lot of non-repeating noise in gap numbers, which is contrary to what people generally think. But it's actually true. If you just look at a sample PE, a lot of things can move, especially in fintech land, in finance land. But you can kind of see why I like Dollar General in terms of value play, right? And if you look at it like a history of the performance of the business, it's a grower, right? It's not like a Kohl's or a Macy's or even Pepsi, right? It outgrown Pepsi quite a bit in terms of revenue growth. It is interesting to see how expensive certain things still are, right? Like, would I still want to buy Coke at 26 times earnings when I could buy Google at 25 times earnings? No, right? But it is what it is. And I do the same thing for Canada. So let's just up here and we'll go to the year-to-date performance because that's more important. And here again, what I've started picking up is CN Rail. Finally. This is one that I've shadowed for 4 years now. I never bought it. And it's finally coming back down to a valuation range. That's amazing. Now, one of the things that took me by surprise when I started following Rail is just how easy they take price. Like inflation accelerates, they take more price. Inflation decelerates, they take less price, but they still take price. And they always take price, and they always generally have earnings per share. Now, CN Rail also decided to take on debt to buy back shares, which is great. But generally speaking, in the long run, buying a business that normally trades around 22 times earnings, and you're getting around 17. So relatively safe. I just started a position. I'm hoping to add to it next year. TD, I always like, so like this year, BNS finally performed. So we're able to take some BNS and start buying some TD. Shopify was performing well. We actually picked up that as well, and that's one that I might keep trimming. We'll see. A BN's one that I'm actually riding out. I haven't trimmed any of it yet. I sold the trap, and what I've done with that one is I've started to add into where the telcos, Rogers. So Rogers actually performs well. Now the telcos are all sold off. Bell's at minus 42% on the year. Telus is minus 24%. And Rogers right in the middle at 35%. Now Rogers is already one of the cheaper ones. It is the cheapest one. And it also has the best scale with the Shaw tuck-in. So in terms of which telco would I buy, it would be Rogers. just based on valuation and what I've seen for performance from the business in terms of execution. And I think the market, it'll be very interesting to see when Bell finally cuts the dividend, how the telcos react. Do they still go down more? Like, will it bring the whole sector down more? Will it actually rally on the day because it's probably getting close to being priced in at this point? Who knows? Now, there is another reason why these things have decelled and decreased is because the immigration was really great for these net ads for these subscriptions for Canada for those three guys, right? And now you're having what's likely going to be the opposite end, where immigration is going to slow down dramatically in terms of rate of change. And so you're going to have slower net ads, right? And then they're going to have to be fighting over probably pricing to get more ads, or they just don't fight. And we'll see what happens. Right now, the market's assuming they're going to keep fighting for net ads and market share, which will be interesting to see because Rogers is the aggressor in this area in my mind because of the Shaw acquisition. It gives them a lot more flexibility as they pull cost out and get on even footing to fight with Bell. So that's why I like Rogers. And to be fair, the business is actually way better than what it was a year ago and 2 years ago, right? They actually have improved, whereas Bell's kind of improved, but it's been a little, I don't know if misleading is the right word. They're just, a lot of their, like, they haven't had free cash flow forever, right? They have CFO positive, and then their capex is so high that it wipes almost all of it out, and then it can't cover the dividend technically. And that was true a year ago, right? That's why we never bought into it yet. But now at these prices, it's starting to get interesting, right? And you could say the same for things like Nutrien. I mean, the QSRs, we kind of talked about Lamb Weston before, which is another one that's looking kind of cheap. We've seen that pullback in the discretionary spend and we've seen grocery stores continue to do well, like Metro, as people, especially on the lower end, continue to tap out, right? And that's kind of what we saw on the US side too, with the dollar stores getting super cheap, right? Whereas the value centers, Walmart and Costco, are taking share, right? And that the easiest contrast there is Walmart and Target, right? Well, one's down 4% on the year, one's up 75% on the year almost. Wow. What else is there to look at? And like these are just like they're ideas for me to flip rocks, right? Like CVS is one I just started to look at, haven't bought yet. I'm kind of afraid to buy healthcare because my success rate is lower in being right. Whereas generally in other sectors where I seem to have more understanding, I tend to do better. Just a healthcare place just has so much policy with government, and I'm not American, and it's just hard for me to be comfortable in healthcare land. But that's kind of what I'm thinking. Like I said, AMD, Dollar General are ones that look really cheap. Obviously, I'm trying to add an Airbnb when I can, when it finally sells off more. And same with Uber, same with Pinterest. And you'll see that when I go through the holdings. Now, this is also something I like to do every year. Like, how is the valuation? Again, large caps look really expensive. Small caps are actually, and mid caps are actually cheaper than what they were in 2014, 2015, 2016, right? That whole range, they're still relatively cheap, right? So, and now you'd be like, well, why is that? And you can kind of see the revenue per share level off in small cap land. And I think this is indicative that they were unable to keep pushing price after the peak in inflation. They stopped pushing price, whereas the large guys were still more able to. Now, large guys are more able to buy back shares, so it's revenue per share, so less shares outstanding also increases it more over time. You can kind of see how that discrepancy on the revenue side. And then on the earnings per side, you can really see the acceleration on the large caps. So the large caps have improved dramatically. So that's one of the reasons why the performance of large caps has been so strong, right? Really outstanding in terms of earnings per share. They've pulled back a lot of headcount. A lot of them became more efficient. And you're just seeing that, especially when they're buying back shares at the same time, like they've been able to. And a lot of them also have the AI and cloud computing and stuff that's more of a value unlock. And to be fair, like I've started shadowing Microsoft now, even though it's at 35 times earnings. I just slowly adding, just started to add a position this morning just to get a feel for it, because the last call, I think there was like 10 billion of their 65 billion was linked to AI already in terms of revenue, which is just crazy. So they're seeing an acceleration that's actually real in terms of not only revenue per share but earnings per share, whereas the small guys and the medium guys aren't participating in it at all, right? At least not yet. So I think that's indicative here with SOIP. It's one of the reasons why they've outperformed the large caps, is because they've literally outperformed. So there is a reason there, not just someone's opinion. All right, so let's go to positions. It's gonna be a long video, like I said. I also want to try out the new microphone that I got and see. So Airbnb is one I've been vocal on enough. I continue to slowly add as US dollars get freed up. But it's just the scale here. And like I said, I do think the rate of change on the RSUs is actually going to decrease. So Q4 will be the last high one, which hides the scale. And then in 2025, for all the 4 quarters, you're going to see the SGA actually only go up with headcount growth. I don't know how much they're growing this year, but I think they only have 7,000 employees, so they're not growing too much. They don't need too many employees to turn the wheel at Airbnb, right? Where Uber has like 40,000 or 30,000 employees. And I mean, Airbnb you're literally going to take rate on travel all over the world. And the scale is just amazing over time. I think that will win out no matter what. I just wish it was cheaper so I could buy more. ASML is one I picked up. I've been doing more research on the EUV side. This one it got really cheap for a bit there. I mean, it's only up 6%. That's one I was hoping to keep adding as it got weaker, but it kind of rallied lately. A lot of things kind of did in November, kind of got away for me, November and December. I mean, which is good for the portfolio value, but bad for deals. Brookfield's one where they've just been executing very well. It's starting to get some traction in America. We saw what's-his-face buy some Ackman, which makes people buy them in the US that like to follow their little leaders. So Brookfield's one I really like. Just solid execution. Like I said, they allocate capital probably better than I can on a more consistent basis. Bitcoin's just there for, I just like to track it. It's something technically you're up 200% on $100. That's just something I like to track because my advantage is reading financials. So Bitcoin doesn't have any financials, so it's hard for me to be confident. Celsius is one that I've kept adding to. I probably will keep adding to. Now I am expecting Q4 not to be great, but the market probably already knows that. But we'll see how cheap it gets. Like, how cheap can people sell it to me? Celsius just screens like when we did the video, we knew we actually talked about it. I wasn't gonna buy it yet. I think it was at $50 and I shopped 80. Looked like an idiot. Now it's down to 26. So this is one I started to pick up. It just, the revenue growth has come in because of Pepsi. The multiples, the earnings per share has come in because of Pepsi. You basically have their main customer basically in control of the revenue and earnings growth temporarily. I mean, what it does, it sets up easy comps next year, especially if international continues to take share, which they have. I mean, as long as they keep winning share in the places that are very established, it tells me the product's still superior. There is some risk here that, like, we have seen Red Bull start energy-free energy drinks and stuff like that. So the energy-free, the caffeine-free or sugar-free, whatever it is, not caffeine-free, sugar-free energy drink market continues to grow. It's just Celsius has recently shrugged off, and I think part of that is Pepsi, and part of that is competition from Red Bull and Monster. Though the whole space is sold off, and honestly, I'm surprised Pepsi hasn't taken more of an active interest in the company. CNR, this is one that I just started. This is just because it's sold off so much lately. It's recently rallied a bit, but that one just, over time, it's very stable. I mean, it's not a competitive business. It's like the railroads are like, I don't know, like I've seen so much regulation with pipelines and utilities, right? And then I go to railroads and it's like nothing. Just charge what you want. Yeah. Okay, take price. Yeah, our expenses went up by this much. We'll raise prices by this much. It just flows through. Like it just rides on inflation and the scales over time. You barely have to upgrade the rail system. You spread it out over so many years. Like, even if you had to, it would just show up over depreciation over such a long period of time. It wouldn't even matter. So anyway, it's just very established, very steady business. Finally getting cheaper. Like I said, used to trade over 22 times earnings. Now it's around 17. So it's getting there. It's not dumb cheap. It's just getting cheaper than it has in the past at least 4 years. Crocs is one. I recently trimmed a bit of it. I wrote it up a few times. Basically, every earnings call, some earnings calls, it shoots down like 20%, and then I can buy it for really, what in my mind is dirt cheap. So anything on $100 when I start getting excited for Crocs. I mean, that business model and the margins there are amazing. Dollar General, one that I own quite a bit of now. Again, I mean, 12 times earnings, and we've seen the history of this company over time. We know that lower end consumers getting tapped out, and I think that's priced in. Like, we're actually at 12 times a really depressed EPS already, right? We've already seen EPS come in 20%, and the multiples coming with it. So you're getting multiple contraction with earnings per share contraction in a recessionary environment for Dollar General, right? So that's very exciting whenever discretionary spending comes back in. Well, I'll have to see what happens. Diversified royalty. This is one I don't know. It just pays this really steady dividend in Canada. It's like Mr. Mike's and Mr. Lube and stuff like that. ENS, so this one's done pretty well on top of the, God, I think it's like a 13% dividend or something that I've gotten this year on it. The pipelines are just, again, very stable. I understand them. I like them when they get cheap based on commodity prices, because sometimes, for whatever reason, they roll with energy prices, even though the models are completely different. And so I like that. So I'm not getting that yet, so I'm not excited about it. It's just a nice place to park money and get a pretty high dividend. Ethereum's one that I own. I think in terms of the two, like I don't own that many coins in terms of crypto, and we haven't talked about that in the channel at all. Ethereum's just one where I think there's some value to unlock in terms of the use cases, but again, it's kind of just my opinion. From what I can read, Google, just in my mind, just an amazing company, still mispriced out of the big guys. We were able to pick this up quite a bit during 2022 and into 23. We've averaged up into it mainly just because there's the strength of I mean, you have, it was funny when AI came out, they're like, oh, Google search thing's ruined. I'm like, nah, the ROIs are going to improve because the targeting is going to improve, the personalization is going to improve for all the advertising. So the return on ad spend for anybody who uses Google in terms of a business is going to improve. So you're going to win share there. We knew YouTube was going to win. We knew Shorts was mispriced. And you knew the cloud, like we kept seeing the backlog just increase every time, right? And then you had DeepMind, which everyone was like, oh, they're not, like, it's, I don't know. And then when you read any like papers, it was all, a lot of that was backed by DeepMind, right? A lot of the breakthroughs, especially on the healthcare side. So a lot of it was like open source from, but from DeepMind, right? So it's like these guys are literally giving value for free, and the market's like, oh, they're not going to make it in the AI world. So like, I think they're the best suited to, just in terms of their core business and their future business. But anyway, it doesn't matter about that for now. It's still not dumb cheap, so that's the only reason why it's not a bigger position. HDIV is just Canadian, multi-sector. Just a covered call, you get a little bit of a decent yield. I think it's like 10% yield, right? And it slowly goes up with the market. HMAX, the same thing, but it's on the financial side, a little bit higher dividend, I think 14%. And that will go up. And what I'm kind of doing here, that's kind of like just where I park cash, get some dividends, and I'm trying to get ideas, right? So I'm trying to wait for the nice deals in CNR, wait for the right deals in Rogers and TD, right? Especially for HMAX, which is financials. I like to buy the financials that have underperformed, especially in the top 5 banks in Canada, just because they're not competitive in my mind anyway. So whatever one I own is probably going to mean revert over time, right? Well, some years BNS and CIBC were the outcasts, right? Royal's always been the gem, but they kind of oscillate, and then all of a sudden one's in favor, one's out of favor. You just buy the one that's out of favor, and then you ride it back up, and then you sell it and you park it back in HMAX. That's kind of the idea. So a lot of this was actually BNS that I rolled into HMAX. Jack, so this one's actually more specific. So this is going to be more active position. This one is really because last year there was a strike. Well, not a strike still, but it was still you're going through the process of the strike in terms of production was still not out. So there's no movies out for kids for a bit. Versus this year where you have Moana, you have Sonic, and both of those are huge for Jax, especially Sonic. Sonic's always been strong for them. You have Dogman in January this year. So you have these strong movies that drive toy sales, and we've seen the toy sales finally stop being so bad. At least that's what Mattel said on the latest call. So especially relative to last year. So that's exciting for me. So I just think this company, and to be fair, Jax, what they've done, they paid off all the debt, all the confusing convertibles, the preferred shares, whatever they were, they paid them off. The debt's all paid off, right? So the balance sheet's immaculate, and the thing trades pretty cheap, right? And that was on last year's earnings, which were great anyway. So I'm expecting a decent Q1 and Q4 relative to what they put up last year. So that's one I'll be more active on the first 6 months of this year. JD, that's just a China play. I need to what kind of happened is we had MNSO, and what was the other one? Lex and FinTech. We had a decent amount of those. Those both rallied pretty hard, I think in September. So we took quite a bit out. Lex and FinTech rallied again, so we took some more out. Actually took all of it out just because it rallied so much, right? When something goes up 140% or something really quick, I generally just take the proceeds and then I might go back in after. But for now, I'm just going to roll it into JD, which, I mean, it screens super cheap. We knew, like, we have seen, like, the electronics actually pick up year over year in China relative to other things where JD scales into, right? So in my mind, it's just, I mean, the balance sheet's amazing, right? In terms of valuations, China's dirt cheap, right? But you could have said that for the last 4 years. Microsoft, just one I picked up. I kind of just talked about that briefly, I think, earlier. Pinterest is one that I keep adding to slowly over time, basically every paycheck. This one, just, they need to figure out a way to unlock 520 million eyeballs that it gets every single month. And for some reason, they are having a hell of a time to get the ARPU. Like, it is going up. Like, it's not small either, right? They are growing revenue. Like, it's high double digits. And earnings per share is starting to follow it. So this is one where I'm excited about, where I think it can go, especially relative to its valuation. It's only worth like $20 billion, and it already has $2 billion in cash, right? Because it did when it IPO'd. But it does have that overhang, like the Airbnb IPO overhang of RSUs. And it hasn't chewed through it as quickly as Airbnb has, because the business model isn't as great yet. And I think that's because it needs to get the ad market better for it. Power is one we talked about a long time ago. I slowly started to take proceeds here. This was an old COVID winner. Just traded off. In Canada, everything traded off really cheap during the COVID panic and could have got deals pretty much anywhere. So this is just a remnant of that. I mean, I just love Wealthsimple inside this company. And to be fair, they get a nice dividend yield. They buy back a decent amount of shares, right? Probably 10% return each year. In terms of shareholder-friendly returns. Pizza. This is just the Royalty Corp. When you go to, like, say when I go to Landmark Cinemas later on today, they'll Pizza there. It's just another royalty, just a rides. Like, we done a video on Keg, and it's like that. It basically just rides on the top line revenue of the company. Same with like A&W.UN. A similar idea. QMax is just another one I kind of tactically put in because I figured this was going into the Trump election. And I figured he was likely to win based on my Twitter feed and a couple other things. So, and we have seen the large caps outperform, especially with Tesla, which I've recently sold a lot of. Not because I don't believe it, just I've traded it a few times. And when anything goes up so quickly, I usually am trimming. Doesn't mean I don't go back in after it corrects a little bit, but I just like to do that because there's other things that are always selling off, right? Rogers, again, I just started a position there. Reitman's one that I wish was performing better. Certain quarters are good and certain quarters are bad. It's just a hard place to make money in retail in Canada, especially with, probably what is a recessionary environment. You didn't have population growth from immigration for the last 2 years. Shopify is one that I've trimmed quite a bit. This one's just, again, kind of shot up relatively quickly. SMAX is just a ride on the biggest, or S&P 500, but in Canadian dollars, basically. So all that is, and you're getting a nice dividend. I think it's like 9%. When you're just riding that. I just didn't want to buy any more US dollars. So it's just kind of sitting there. Again, I'll probably buy into other things as things get cheaper, but right now I just put it in the market for now. What else is there? TD is the one I just started a position in. Kind of talked about that already. Tourmaline's one, again, COVID winner. Just, in my mind, one of the best executed in terms of nat gas plays, which technically ACO was very weak for a long time, but the company's held up better than I thought they would. They kind of looked through it. Uber, this is the one where I've been selling the US dollars, was a big gain. I've trimmed most of it, and then I've basically been buying it in Canadian dollars lately, including today. AMD is one that I've started to add to quite a bit. This is one, again, I just think it's likely to accelerate at a time when the market obviously thinks that AMD is not going to participate in AI. And the sales is actually showing up. So it's kind of, I think it's slightly, like, it's still priced high, but I think the earnings per share growth is probably mispriced relative to valuation. But we'll see. Who knows? This thing can correct even more. And I'll keep buying it as long as the performance is there. So the next couple quarters can be very important for me to get more confident in this. But I've done enough with research and intel and stuff like that, right? Yams, so that's just the Amazon side. Again, all these things are basically just covered call plays. It's basically a way to get dividend yield while participating in the rally. So Yams, just Amazon. Amazon's just a beast. The scales there, like you notice, as long as you know the capex cycle, it could be a free cash flow machine. And I mean, the moat's amazing. The cloud computing business is amazing. Graviton chips are amazing. Why Google's just something I put on. I think it was when the quantum computing news broke. It broke during the afternoon, and Google was actually flat on the news. And that basically it was like, I think it was the CEO's tweet, Sundar, about just how much quicker it was relative to supercomputer, the existing supercomputers out there. And like the thing didn't move, so I just put some money that I had in cash into why Google and wrote up. I might trim that. It was just more like a trade. Maybe take it back into NVIDIA. NVIDIA is just, I mean, just own it, just to follow it a bit, just to see what's going on and what the hype is. Again, it's had crazy last 2 years of growth. It probably still is going to grow quite well, but again, it's going to be hard to keep growing the G rate that it is right now. So we'll see how the market treats that. In my experience, it doesn't like decels. So we'll see. But I like to just hold it a little bit there. It forces me to track it. And Tesla is one that I've recently sold quite a bit of because it just rallied so much after the Trump election. And then what else? Advantage, another nat gas play. Canada, Bank of Nova Scotia is one that I've been actively trimming. CTS is one that I've held for a little bit. But still, honestly, still trying to familiarize myself with the company. PayPal's one where I might trim. I don't know. It's not dirt cheap anymore, but the performance is there. They have made the platform or the product offering better for businesses. And Braintree's not going to be as margin dilutive as it has been in terms of transaction margin dollars. So Shopify, I already talked about that. We've trimmed that one quite a bit, again, partially because it rallied so much lately. Vermilion's one, they just did an acquisition. Kind of sets, I was hoping that they paid, like after they paid down debt, they'd start buying back more shares aggressively. Instead, they decided to make an acquisition. This helps them longer term, but shorter term, it's more mixed because now you're going to have to pay down debt again from the acquisition. It is a big acquisition. It helps the reserves dramatically. It helps them make sure they last for the next 10, 15 years, right? Which was one of the bear cases against Vermilion. So it makes sense. It's just from my investment perspective timeline, why now? So I'm going to be very watching the TTF market. And this is one that I've currently actually, because it's been under pressure, I didn't have too many losses this year. This is in a taxable account. So I've actually trimmed some and I'm hoping to add some back. After the 30-day window, right? That's just the tax thing. Maybe I'll do a video on tax and planning, stuff like that, things that I've learned over time. Airbnb, we already talked about that. I own 16 at Wealthsimple, another 13 at Scotia. I trade. Yeah, so the two. That's why the user interfaces are different, because they're different platforms that I own the positions in. AST Space Mobile, we saw most of this. It just rallied so much. Like when we did the videos at like $2 and it shot up, I think it went to 30 something. So we just trimmed it. It's still a moonshot play if it's correct. So far it's executing on track. It's just there's a lot of risk embedded in this company. And there's a lot of dilution, though. Again, the higher the share price goes, less dilution there will be to the ultimate end user, the ultimate investor. So it's kind of these things where it's like a true momentum play. Like if things are executing very well, this thing's going to keep going up, and then they're going to be able to issue less shares for more money, right? And it's just because it needs the money to keep launching the satellites to get the actual business model up and going. So the higher the share price is, actually the lower the R, right? Lower the cost of capital for the company. So that's just a true momentum play in terms of cost of capital engineering. BlackRock. So this one of my favorite businesses, actually. It's up there with Airbnb and Pinterest in terms of what I think the business is. I just wish it was cheaper. Basically, anytime I see BlackRock at 15 or 16 times earnings, like we did earlier in the year, we're going to buy it. All right, I'm going to buy it. Dollar General, we talked about that. I also own it here. Again, I think it's at 12 times earnings on a depressed earnings. And the long-term growth trajectory of Dollar General is very specific, and they keep winning in rural America. Basically, they perform the role of Walmart wherever Walmart can't perform their role, right? Basically, population density. Freeport McMoran and copper, we talked about that so long ago. I am trying to get back into copper. I was hoping that this, like the rest of the world's basically stock markets haven't been great. We haven't seen a lot of growth outside of America, right? I was kind of hoping copper would be under more pressure and get some easier prices to buy some things. We did have quite a few other copper plays like Capstone and stuff like that, but we sold some of it. IMAX, this is one that was just mispriced last year. It's one of, maybe that's what I'll do. Maybe I'll do a video on like the top trades of 2024. That would probably help me, because there's been some good ones, but we should do some bad ones too. Balance it. Good trades, bad trades, like the top 10 or something. That'll be fun. Maybe I'll do that. It'll help me remember, because the portfolio, like I'm very active and things change very quickly. And I have no problem getting rid of them, right? Especially when they perform. Though sometimes I like to keep a token position, right? Just to see it and force me to look at it. What else? So IMAX, anyway, just mispriced last year, like horribly. Like the box office is never going to improve. And you literally had last Oscars last year. You had the Oppenheimer win, and the the director, the first thing he said was "Thank you, IMAX," right? And the IMAX stock didn't even move. I was like, what the fuck? And and you knew they were taking share. If you want your movie to do well, you want it on IMAX, you want IMAX cameras. And I was like, okay, this company's obviously in. We saw basically IMAX was trading like an exhibitor. It was trading like Cineplex and I should say AMC because that one's kind of its own little thing. But basically, a lot of the exhibitors are under a lot of pressure, right? Especially during the strike part. And then we knew the slate was going to be better than this year, right? Or last year, even with Barbenheimer to compete with. We just knew there was more movies coming out. So it's not no longer a no-brainer at this price. It's just longer term. This company's very special. Balance sheet's still fine. Jax we talked about already. Mobilize one. This one's a crazy one. It swings from like $10 to $20 on nothing. Technically, in terms of in terms of businesses and what I want them to do, this one's underperformed my expectations. They just haven't executed it well. They're getting beat in China on the low end. I was hoping to get more products like automobile, like OEMs, to say they're using Mobileye this year, and it's been kind of like, we got Volkswagen now, right? So they have gotten some. It's just slower than I would have expected. And though, to be fair, the automobile industry's been destroyed this year, especially European, with just getting dirt cheap, right? All of them are. So maybe they're being more hesitant. Though at the same time, you have Tesla going full speed ahead. So the slower the automobiles move, the weaker they're going to be, and they won't even participate in autonomous driving at all, which would be very bad for them in the long run. Pinterest we already talked about, just one that I currently own and keep adding to, basically under $30. And then Spotify's one I've trimmed a bit of. I keep trying to trim it. It just keeps going up. That one was just they're taking price. We've talked about that before. Basically, just taking price, and the market was basically saying we don't think your margin's ever going to improve. And then literally all management teams said, well, it was going to improve because we're taking price, we're raising the subscription price, right? We're increasing the advertising market for the. And then they also finally scaled enough on podcasts to make that no longer money losing, right? So, and then they have audiobooks now. So they're expanding their product offering, right? Similar to what I think Airbnb is going to do. Don't not raise price, but just increase the product offering. But yeah, that's a lot of businesses to go through really quick. I'm probably going to re-listen to them myself and see which ones I need to do more digging on, or which ones maybe I should consider selling in the new year. I do generally try to free up some cash after the tax season, so probably right around New Year's Eve I'll sell some more and try to buy some stuff in the new year. But yeah, that's about it. I'd like to know your thoughts. There's a lot going on. There's always cheap things somewhere, right? Like ASML or Dollar General, right? Or possibly AMD, even though it's still priced like crazy. But yeah, I've tried to reduce the amount of holdings, but it's hard. There's just so many things I want to buy. I have started to use some ETFs to try to basically consolidate and keep ammo, pay a dividend while I wait for an idea, and then just jump in. I'm kind of using it like a bond proxy, even though it's nothing like a bond. But that's kind of how I'm using it, what I've done back in 2019. Though maybe I will consider bonds again to de-risk a bit, just given how expensive everything is. But it's interesting anyway. Interesting time. A lot of the businesses are doing a lot of things, especially in tech land. It's definitely not slow. But yeah, that's probably gonna be. We'll see. I might even do a couple more videos for 2024 year end, and if anyway, it'll be the beginning of 2025. But yeah. Anyway, have a great Christmas and happy holidays. And I'm gonna do a couple more videos, and happy New Year if you don't check it out till then. Bye now.